I will move over now and let William present. He is um, a professor of applied economics and agribusiness at North Dakota State University. He focuses on risk and strategy and agriculture and agribusiness.
So let me make a few comments here and then we'll proceed. You know, I'm a Blackboard guy, so I'm sorry. Yeah, Blackboard and chalk guy. So this is not new to me. It's just part of life. So just for your reference, I spoke to this conference a number of years ago, and I guess that's why you asked me to come back. And I wish I was there in person, but this is the way we have to operate. Some of you may know I went to school at the University of Manitoba and graduated in 1980. And since then, I'm a professor at North Dakota State University. And I'm involved in a lot of things in agriculture, particularly agriculture marketing in this country and around the world. I have clients or projects in 11 countries, which I'll draw into a bit here. I've been asked to give kind of an overview of the big things going on in agriculture. So I'm going to talk about a number of these. So you know, I do mostly teaching and risk and strategy. I have a pretty heavy research program on those topics. We have a Center of Trading and Risk here with a trading room, and I have an endowment that supports my activity. I'm also a board member of 4 fairly large companies in agribusiness worldwide, primarily working in buying and selling, investing in agriculture and logistics. So I'm going to talk about ag technology. I was asked to talk about supply chain problems, changes, competition, Russia and Ukraine, and maybe make a few comments in closing on what that means for all of us. Maybe I would just say here, you know, here's my world. Here's a world of agriculture today. We have Russia and Ukraine lurking around behind the scenes here in a big way. We have the morphine of US and Canada marketing systems and logistics systems. We have Lula swinging a bat in Brazil, and we have Brazilian soybeans taking over the world, and we got a war in Russia and Ukraine. So that's a lot of stuff going on in agriculture. Not a day goes by that something significant doesn't happen. So I have to speak in the United States frequently, and I like to bring to the attention of this is that many of the institutions, much of our policy and much of our strategy of companies has been based around the fact that historically in the 1970s, the US was the dominant producer and exporter of everything. And this chart shows an evolution of this in 5-year periods, in this case of corn. And you can see now we're really kind of a residual supplier. And I point this out because it is kind of significant. Our policies in this country, firm level strategies are built around a time when we were domineering. That's corn. And here's the same one in soybeans. I'm sorry, this is the same one in wheat. As you know, we're a really pretty inconsequential player now in the case of wheat, in part because of growth of wheat production in the Soviet Union and the FSU countries. And here's soybeans, which is intensely rivalrous, but it's the market where we have a more domineering share than anything else. So I think this is a challenge for a lot of firms and policy in this country if they haven't acknowledged it so far. So I'm heavily involved in Russia and Ukraine. You'll hear me speak on that later, but I'd like to, quite often people want me to talk about the Russia-Ukraine, but I want to give a little highlight going into the Russian-Ukraine invasion. Just on the left-hand side, look at all the things confronting world agriculture with climate change and water shortages, major changes in ag technology. We have the events of Russia, we have China, we have a new president in Argentina. We have the development of sustainable aviation fuel and renewable diesel. We have decline in US wheat. We have AMLO in Mexico trying to get rid of GM corn. We have Brazil corn going to China. We have all the risk in the Black Sea regions. We have farm to fork in Europe. And all of this has resulted in a lot of volatility, both in terms of shipping costs, prices, and commodity flows. In 2021, we had a drought in the Northern Plains. We had pressure for sustainability. We had oil prices, as a reminder, going from a negative value, if you can believe that, to 140 bucks a ton. We had Chinese restrictions on fertilizer, which are renewed again this coming year. We had COVID, we had labor shortages, we had a drought in winter wheat, supply chain problems. And then on February 24th, we got an invasion of Ukraine. So there's a lot of things that are going on, inclusive of the invasion of Ukraine. I'll speak firstly on climate, a few words. This is a headline a week ago: farmers race to innovate climate change threatens an African food. Here's all the headlines just in the last week alone, where we're talking about the elevated temperatures, the shrinking of the Amazon River, and others. I point this out for the following, well, in part for the following reason. To me, it's very interesting. I do a lot of work for the Panama Canal. We did the feasibility study for the original Panama Canal expansion project in 2004. We had to make projections 25 years forward with and without a new canal, and what was the risk of expanding. And it's kind of interesting to me, and very serious in the world commodity market, that in the past few months, we've had extremely constrained flows in the Panama Canal due to water shortages. We've had restricted flows out the Mississippi River because of water shortages. The city of New Orleans is risking running out of fresh water, and we have lower water levels in the Danube and Rhine River. And you can see what happened to barge rates in this country. Now I went back to my work in the Panama Canal in 2004, and we estimated the probability of what's happening today, and the probability of that occurring was less than 2% chance, and it's happening. And I point that out because I never used to pay attention to climate change, and people would ask me, well, don't you worry about climate change when you think about new GM traits or new varieties of commodities or the Panama Canal or port development? And I said, I got 20,000 variables in a model. I can't worry about anything else. And since about 2012, I've kind of realized the significance of climate change and that it's having on the world economies and world agriculture and world logistics. And I think it's something we all have to pay attention to, but that it has emerged to cause this development of ESG and sustainability. And when I first was asked about these things, I didn't really know for sure what it meant. So I had to read the book on it called ESG Investing for Dummies. And I'd like to just make a few comments on that. It stands for Environmental, Social, and Governance. And I try to reach out to find out where the origins of this was. And I believe that this was a survey of consumers conducted and sponsored by Cargill, done by the Hartman Group. And they surveyed consumers in the United States and found out that 37% of the consumers, primarily millennials, would be more likely to produce products if they were produced with sustainable practices. And as a result of that, at least in this country, there's been a mega shift towards sustainability. And we can have big arguments and fights about it, but when I spoke about a year ago right now to Bunge's board of directors, the day before I spoke, there were two headlines. Bunge and ADM were given major awards because of their efforts in sustainability. And immediately following that, Cargill announced their program called Regrow and how much effort they're putting into this. So these are big companies of world agriculture in this country and your country making initiatives towards sustainability. Last week, Cargill put out their ESG report. Ardent Flour Mills, the biggest flour milling company in America, put out their ESG report. And everybody's kind of on board with this effort towards ESG. But I'm sure this is going to be a rocky road in the future, because in the past few weeks alone, the Wall Street money and the Financial Times are kind of saying there's kind of a financial backlash about this ESG movement. And, so there's going to be a little fight on this. And certainly that was occurring in COVID, the COP 28 meetings in Dubai the past few weeks. So that emerged to develop the carbon markets, which you are further ahead of in this country than is this country. But this is driving varying mechanisms that vary around the world to incentivize growers in the agriculture sector to reduce their carbon footprint, if you like. And we have many different types of companies and contract and contractual mechanisms moving forward in that. That has given rise to the development of an industry we never even had before called renewable diesel. And that's probably we're at the forefront of that, but other countries are as well. We have 18 projects in this country to develop new renewable diesel plants. And that's giving rise on the right-hand side. You can see the estimated increased demand of renewable diesel in this country. And when that first started commencing in 2021, I show on the left-hand side here, the price of soybean oil was typically about 20 cents a pound, and immediately went to 90 cents a pound and gravitating towards about 50 cents a pound now. And as a result of that, everybody's investing in new soybean crushing plants. In this country, we need 8 to 10 million acres more of soybeans to support that. And in your country, as you know, you've got a tremendous growth in your canola crushing, most of the oil of which is going into the United States to support that renewable diesel industry. And it doesn't take very long till you're now talking about sustainable aviation fuel, which if fully adopted could require an additional 20 to 30 million acres of soybeans or oil seeds. And having said that, just so you know, it's not without controversy. The headline in the Telegraph a couple days ago said, airlines' shameless greenwashing has become embarrassing. So here's the location of all the new crushing facilities in America. You have a map in Canada. I'm sure you're familiar with all that, so I won't elaborate on that too much. But that's going to have the impact of, you can see in North Dakota where I live, we have 3 new plants. We're going to go from exporting 95% of our soybeans to consuming 70% of them locally. It's going to result in expanded acres of soybeans commencing next year. Big export shipments of soybean meal in competition with Argentina will result in probably pretty ruinous competition. Increase of canola oil from Canada, which is already occurring. And we have been, and I suspect will continue, to probably be increasing our oil imports into the East Coast of the United States and or soybeans, in part because of this development of renewable diesel, but in part because of our higher domestic interior shipping costs. And nobody wants to talk about this, but a lot of people in the East Coast and in our city of Wisdom, Washington, will want to talk about food price inflation. Of course, the grain and oilseed producers say these efforts don't have anything at all to do with food price inflation. At the same time, Krispy Kreme and our other industry leaders are having Senate and congressional hearings, what they call diesel versus donuts, and as a result of these renewable diesel requirements. I was asked to talk about supply chain, so let me just make a few slides on this. I do a lot of work in it. And this kind of evolved in the period of time immediately following COVID, and resulted in more congestion and an increase in demand for products, compounded by labor shortages and the advent of nearshoring, and exacerbated by the advent or use of just-in-time manufacturing processes. In the grain and oilseed sector in the Americas, at least, this was compounded by the adoption of precision scheduling of railroads, the Chinese trade war, and labor shortages. So I do a lot of work for a number of the railroads, and one of them spoke to one of our boards during right after the Chinese trade war. And the person said, you know, as a result of the trade war, we had massive reduction in capacity, not only in agriculture, but in everything. And if the phase 1 agreement goes back into place, we can expand and be no problem expanding with locomotives or cars, but the biggest problem is labor. And to this day, they still have trouble hiring labor, even though their wages are very high. And this continues to be a problem in the Americas, in the United States, I'm guessing in your country as well. But the impact of that was for reduced train speed, increased dwell time, reduced velocity, and adversely impacted what we call secondary rail car market values. There were congressional hearings during this time period, and Foster Farms, which feeds chickens in the California market, testified against Union Pacific Railroad and said, your failure to deliver is about to kill millions of chickens. So that was pressure on the STB to intervene. So to illustrate a few things, I'll show you some slides. And the amber colored line shows the period of COVID. So in America, we have a fuel service charge, which you can see erupted, went from nil to very high level in the period of time after COVID. This shows velocity on the BN system, which is averaging normally about 3, but in the period of time in late 2022, it reduced to about 2. So what that really means is a reduction of capacity by about 1/3, which is a big problem. Train speed is shown on the lower part, and you can see how that was reduced. So we modeled the Pacific Northwest supply chain, and we incorporated as much data as we could, including issues of export demand and the randomness, inbound shipping, velocity, on-time arrival, late arrival, demurrage, storage capacity, and everything else to try to understand what drives this supply chain. And this kind of gives you a picture of the weekly shipment of corn, soybeans, and wheat. And that black bar on each graph shows the average across many crop years. So think of yourself as a supply chain planner, and you're confronting this level of volatility, where the range in any given week you could see across years could be as low as 400,000 to as high as 1.4 million. So that's the range of volatility of demand. I point that out because most of the supply chain problems are exacerbated by volatility in demand. So we modeled this to death, and you don't have to worry about it so much, but I'll show you some of the results. This shows on the left-hand side the distribution or risk of costs for simulated movement. And the number one variable that causes uncertainty in this supply chain is annual demand, is our forecast of demand. Followed that would be our secondary railcar market values, and then velocity and demurrage. But by far, the most important factor causing supply chain problems is volatility of annual demand. Our results show that we can reduce that risk by buying more forward shuttle trains. We call it the primary shuttle train market. Trying to convince buyers to buy further forward, which reduces the risk, but it's all exacerbated by volatility in rail transit times. All right, so just last week, I do this in my class, and I don't know if you all remember or realize what happened last week, but we had the bombing of the Red Sea, and you can see the Suez Canal and where the bombs hit. And I have to remind you, not remind you, but emphasize how sensitive the world marketplace is to these developments. So this happened a week ago Monday. So this shows all of the soybean ships that are afloat on that day. So you can see, take a look there. Those little green dots are the ships that are afloat. This is from Thomson Reuters Icon. So you can see the movements out of Brazil going around the Cape, going to China. You can see movements out of the Black Sea, going through the Red Sea and the Suez Canal to China. And you can see a number of vessels going out of the US Gulf, going ultimately to the Black Sea to go towards China. And you see hardly any movement at all going through the Panama Canal because of the impact of the reduced water flows and their reservation system. So all of these ships are being impacted. The ship owners are forcing war insurance to be applied. Shipping costs go up. Ships are being diverted away from the Red Sea to go around Africa, which adds about 14 days transit time at about $2 million per vessel. Some origins are shifted to other origins. So these have major repercussions on the supply chain. So I teach a seminar that I've been doing for 41 years now to foreign buyers, and I have this year 35 students from 28 countries. And we have a session talking about holding buffer stocks or holding inventories as a way to manage supply chain risk. And we have a spreadsheet that we show how to determine the optimal level of buffer stocks. So this actually is from a real company in North America. I won't say who, but it's a processing company that processes a lot of barley. And you can see their sawtooth diagram of demand and inventories. You see inventories go down to about 30, but they never go below 30. So that 30 is their level of buffer stock or inventories to protect themselves against uncertainty in the supply chain, price, quality, yields, whatever it is. So it says that their optimal buffer stock should be about 30. And so we should draw down to 30 and then we should replenish. So we present this. I give a case study in my class, and I'll never forget that a young man from Portugal in my class named Jose. And he raised his hand and he says, "Could I read you a text message?" I said, "Yeah, go ahead." He said, "I just got a text from a supplier, and I have 2 vessels being loaded in the St. Lawrence." This was in the end of September. 2 vessels being loaded in the St. Lawrence, and the supplier had a fire in their elevator, and they were going to be late by 2 months, and I don't have the inventories. And I just rolled my eyes because that probably costs about $100 a ton because of that. So I'll make a few comments about international competition. And so here's, start out with my friend, Mr. Malay in Argentina, won his election as an extreme libertarian and took office on Sunday and met with Argentine farmers the last couple of days. But this is really important for us and for you because they typically have about 12, they have an export tax mechanism on corn and soybeans at 12%, 33% on soybeans. And they have a pretty domineering position in world oil of soybean meal and soybean oil, as well as barley, wheat, and corn. So everyone's kind of holding their breath as to what will happen, but the significance of it here I can show you in the top left graph. This is not mine, but that black bar shows the historical export tax on wheat. And the blue bar and the red bar shows their acres planted. And there was a period of time when the export tax went to zero, and you can see how their level of plantings increased substantially. The same is true on the right-hand side here in the case of corn. So everybody's looking to see what's he going to do about the export tax and what's going to happen in Argentina. Headlines this morning, I guess, was that he met with growers yesterday, and they seem to suggest they're going to lower the export tax on corn and wheat, but not on soybeans. And the expectation is that would increase their wheat crop by 60%. That's a big number. So I think that'll have a big impact the coming years. And we'll see what happens. I mean, he's got to live in a political world. So we get kind of tired of looking at these two guys, but that's where we are. And so you know who they are, and they're meeting all the time. I have to tell you, and you probably know, but I have to emphasize in this country how important China is to the world of everything, but agriculture in particular. We used to talk just about Chinese soybeans. You can see their growth rate of soybeans growing at a rate about 18% a year, going up to about 100 million metric tons this year. USDA has them going to 140 million metric tons every year, but people say they're topping out, but they never top out. So they dominate the world market for soybeans. And that's normally the story, but now we realize that they dominate the world market for corn. So the top bar in red shows their imports of corn. You can see till about 2010, 11, their imports were nil. They were self-sufficient. They started importing. They had a problem because of something we call Mirror 162. They diverted all their purchases mostly to Ukraine. And then in the past few years, they went up to 25 or 30 million metric tons, which is exactly where they were projected to have been at this time with the USDA projections in 2010. So you can see in the lower chart that is really dominated now by Ukraine and Brazil, and the United States is a pretty minor player. And then we thought that's only corn and soybeans, and then now we're realizing that China is becoming what would be one of the biggest importers of wheat. And as you know, in your country just last week, they were said to have bought in a cargo of durum wheat, which is unprecedented. But you can see here they're pretty much dominated here by Russia, primarily, and to a lesser extent yourself. And then my colleague who works in livestock, he said, don't forget to talk about livestock because China has become the biggest importer of beef, at least from this country. And that's shown in this amber colored line. So China is really, really important. And I guess that's not going to go away. So Jamie wanted me to talk about Russia and Ukraine. I've been involved in Russia and Ukraine since '91 when I was hired by the US and the Russian government to advise them on how to change the rules and regulations to facilitate privatizing their commodity marketing industry. So then commencing, and I've been to Russia many times, 86 times. So I was given an award in 2012. And then in around that time period, I was hired by a venture capital company, a private equity company in New York named NCH Capital to advise them on risk and strategy and making acquisitions in Russia and Ukraine. And we've emerged now to be one of the largest farm corporations in Ukraine, one of the largest ones in Russia, one of the largest traders and handlers of grain in Ukraine. I've been on the board of directors since 2015 and recently was appointed the board chairman. So kind of my pulse check is pretty close to Russia and Ukraine from that perspective. So here's the headlines just a few years ago. That boom you hear is Ukraine's agriculture. And so everyone's kind of looking what's happened. And it's significant because traditionally, historically, those two countries were considered the breadbasket of the world. They had Soviet legacy farms, which were called kolkhozs, which were about 50,000 acres, which were large and state-owned, and they came to be divesting in the early 1990s. Corruption is overwhelming in both countries and continues to be the case. And so that's a challenge in operating there. Because I get asked to speak somewhat, I'd like to share some war stories, and you probably have read about these, but we really have shortages of farm workers. It's now worse now than before. In fact, we may sell a few farms so that we can move our workers to other farms. We have shortages of ag inputs, diesel. We have stealing of ag inputs. Cash flow problems are pretty horrendous. We're making money, but not as much as we're used to. The result of that is tremendous reduction in plantings. There was a shortage of storage, so we put in place a big import program on storage bags from Edmonton, in fact, funded by the Buffett family or the Buffett Foundation. Demining is a big part of our activity. We're shifting our crops from corn to primarily oil seeds. The Russian army is brutal. Everything you read is absolutely true. They raid farms, they steal grain, they ship it to Syria. They steal equipment, give you an IOU, and they'll pay you back at the end of the war. They bomb facilities, missiles hit tractors, landmines in fields. They take over farms and give you a sharecrop arrangement. And we have farm workers go in to become POWs. So this is their production of Ukraine on the left, Russia on the right, where you can see their growth in production of wheat and exports in decline in recent years. Here's the same thing in corn. You can see corn is more important in Ukraine. And corn is one of the biggest changes in the world because they're going from exporting about 25 million metric tons to about 10. So a few stories here. Russia wants their own grain trading giant, VTB Bank, which is one of the biggest banks in agriculture in Russia and Europe, involved with Sberbank. A former student of mine is the head of ag there, named Alexei, and they wanted to promote the Kremlin to sponsor the development of a Russian grain champion because they did not want to rely on Western countries. So they created a company called the United Grain Company, which for a while had 70% of the export market. And so they quickly took over that market. Then there's been a lot of flurry of activities, but at the end of the day, without reading all this to you, the Kremlin wanted to reduce their dependence upon all Western countries from countries who had sanctions against them. And they came to be called unfriendly states or unfriendly countries, including the United States. So he put a prohibition on companies from unfriendly states from owning Russian companies in the grain loading sector. And then over time, he wanted to take over more and more control of that trade. And so here's a headline of it last spring. Russia moves to seize naughty Western companies. That's mostly US-based companies. So in April, each of our champions, Dreyfus, Viterra, Cargill, Bunge, and others all had to leave and exit the grain trading industry in Russia to be replaced by a cabal of Russian grain trading houses. So that ultimately gives the Kremlin greater control over grain marketing. And so it's my words to say this is kind of a STE on steroids, where they now control the handling, they control the disposition to exports, they control the price, they finance, and they do many, many things, not much different than your Canadian Wheat Board when that was in operation. The export tax is a pretty important mechanism in Russia. Here's a history of the export tax. A few years ago, it was up to $100 a ton. It changes weekly, went down to about 70. Now it's about 50 bucks a ton. That's the blue line. And that's a mechanism that the Kremlin applies because they want to keep lower domestic prices. Given they control about 40% of the market, this has a big impact on the overall world market. So he wants to keep domestic prices low, to keep domestic food price inflation low, and allow them to be more competitive and selected in how they do their exporting. So take a look here. If you can read the upper left-hand chart, this shows the top two lines, red and blue, are the Matif price and the price at the export port in Russia. And the yellow and black lines are the prices in the central black soils region of Russia recently at about $100 a ton. And everybody knowledgeable say, how can you produce and make money at $100 a ton? And the answer is, since at least 2022 crop, the Kremlin's provided a subsidy to the agriculture sector. This was just announced a few days ago at 10 billion rubles. So then we got this war, and this is the map probably you're all familiar with and seen, but you can see the 4 territories that the Russians want to claim control of. They're in red. You can see the red bar that they're trying to, that's the battle lines that are being drawn right now. And so I'm going to speak a little bit of detail on the Russian invasion and the impacts and the outlook because of it. All right, so the first thing that happened is beginning in early 2022, after the war, it didn't take very long till people started getting concerned about how are we going to feed the starving people in North Africa and the Middle East. This was the headline in the Wall Street Journal, and the European Union did not take them very long to conclude, we already have an immigration problem. And if people are starving in Africa because we can't export out of the Black Sea, we're going to have a problem of more illegal immigrants coming into Europe. So they initiated a process to develop what came to be called solidarity lanes. And that commenced on May 16th. These are headlines on that day, which said that we got to find a way to get crops out of the Black Sea. And that came to be called the Black Sea Corridor. That went into place in July. So here's what happened to Chicago wheat during that time period. If on the left-hand side, it's wheat futures of Chicago, and wheat prices, that peak was May 16th. That is when they began negotiating the Black Sea Corridor. And Chicago prices fell $2.35 in one day, and over time fell $3 a bushel, and the Gulf bases fell from 170 to 140 in response to those developments. So that's very, very critical and continues to be critical today. So here's the alternative routes, those things called AP, those are locations of our facilities. But you can see Odessa is pretty magical because that's historically the lowest logistical costs in the world. Their freight shipping costs, I'll show you a slide in a moment, but before the war was about $20 a ton. So that's from North Dakota to the West Coast, we're about $70 a ton. They're $20 a ton. Even your freight rates are substantially higher than that. So by far the lowest shipping costs in the world, which allowed them to expand production and exports in a low-cost way, but everything wanted to go through Odessa because that's where the cheap costs were. Odessa shut down because of being bombed and because of the landmines and the sea mines put in place. So everyone had to find alternative routes, and you can see the alternative routes that were developed. The predominant one was going down in the lower left-hand side by rail to a town by the name of Reni and a town by the name of Ishmael. And then it would be loaded on the Danube and go by barge down to a city by the name of Constanta. Alternative routes would be going through by rail across the border to Poland, switching rail tracks and then being exported out of the North Sea. So we model this, and I'll give a little feel for that as we go forward, but I think it's important for you and for us to know that during that time period, rail rates increased by 70%. So if you remember watching the TV, a lot of the infrastructure was being bombed. So it cost money to fix that. So in response to do that, they raised rail rates 70%. And a couple of weeks ago, they announced that they'd raise rates again by 40% in January on commodities, not on passengers. And commodities are primarily agriculture. So that's a big deal. So this is a very detailed chart. It's my work, and it's something I'm publishing on, but it's my internal work with the company I'm involved in, but it's pretty well public information. But if we can see here, this first column shows the elements of costs. So before the invasion, going through Odessa, the rail shipping cost was about $20 a ton. The total cost from farm to ship was $31 a ton. That resulted in an average basis to the growers of $37 a ton. Very attractive. And then under the post-war invasion scenario, we have Odessa, Constanta, and rail through Poland. And you can see how, just pointing to Odessa, the rail shipping costs went up to 35. Elevations went from 8 to 30. And total cost FOB ship is now $70 a ton. Going through Constanta and Poland is even higher at about $115 to $130 a ton. So I just want you to understand the cost of exporting went from 31 bucks a ton to $70 to $130 a ton. That's a monster impact on world commodity trade. So Ukraine went from the lowest shipping costs in the world to, I believe it'd be correct to say, the highest shipping costs in the world. Okay. So then just another point, they normally export about 7 million metric tons a month. In the post-war environment or the post-invasion environment, the capacity is severely restricted, which has the effect of forcing shipments to diverse ports. So just a bit of message on geography here. I'll show you this map on the left. All those green dots are ships. And on the right-hand side here, if you can see my pointer, that's the famous Snake Island, where it's a Ukraine territory, but the Russians took it over, and then later the Ukrainians took it back from the Russians. And you can see that canal, that's the Salina Canal, that's similar to the Panama Canal, but its capacity is only about 4 ships a day. And then in the upper square up here, that's the Danube River. So that's before it was being used very much. And last February on the right-hand side, here's a picture of the ships. You can see there's much less congestion, but you can see the ships on the Salina Canal and on Danube. And this congestion over here is where the rail line loads barges on the Danube River to go down here on the interior to go out the port of Constanta. So that's the prevailing alternative route to Odessa because of the Black Sea Corridor Agreement. Here's the disposition of ships a few weeks ago. You can see Odessa up here, the Danube River and Constanta down here, and the Bosphorus Canal of all the ships waiting to get in. So it didn't take very long in this Black Sea Corridor Agreement where Mr. Putin decided this was not such a good deal for him. It was a nice idea for food going to Africa and other countries, but for the Russians, he had 2 complaints about this, or the Kremlin had 2 complaints about this. Number one, it did not do anything to facilitate them shipping fertilizer out of the Black Sea, which is a big source of earnings for Russia. And secondly, the Black Sea Corridor Agreement did not do anything to allow the Russian international financial transactions to use the SWIFT system. And the countries involved said, well, the SWIFT system is a banking issue, not a government issue. So we can't force the banks to use the SWIFT for Russian transactions. And the Kremlin said, well, we don't care, just fix it. And nobody could fix it. And it really hampered Russia's ability to trade internationally. So in July last year, he said, I'm pulling out of the agreement. You guys figured out how to fix it. I'm pulling out of the agreement. So the evolution of this is when the corridor first started, we had increased ocean rates, demurrage, war premiums, and others. Then we had Russia withdraw from the Black Sea Corridor Agreement. On that day, Russia bombed Odessa and Reni, which was the rail transfer point. And then the Ukrainians developed what the Ukrainians call the humanitarian corridor, which now I believe I'm reading that is sometimes called Grain from Ukraine Initiative. And it's illustrated in the upper right-hand graph up here, map that you can see. The original Black Sea Corridor went through that pink line, and the Ukraine Initiative has them channeling ships, hugging the border of these countries within 12 miles. So all of those are NATO countries, and the idea was that the Kremlin would not bomb ships when they're going that close to the NATO-born countries. Well, the impact of it was that ships were protected. There were more ships coming into Odessa. There's still a war insurance premium. There's high demurrage cost, and it's supplemented by shipments going through Constanta, Poland, Croatia. Okay, so We put a model together on this. That's what we do as academics, is build models. And this is on corn, but we're doing the same thing on wheat right now. And we did it to try to analyze what is the effect of these logistical developments. And I'll just give you a synopsis of the results because they're pretty important. So if we look at before and after the war, this is a change in market shares on corn from Argentina, Brazil, Ukraine, US Gulf, and US P&W. So you can see in the case of Ukraine, they lose market shares to most countries, but they continue to dominate in the case of the Middle East and the European Union. The US Gulf, we lose market share going to China. And the US P&W, we lose market share going to China. We gain in Japan and South Korea. But the big sleeper in this is Brazil. And you can see how Brazil's exports to China have increased substantially. So this shows it up, blows it up a little bit when we look just at the effect of Brazil. It's interesting, and you should be aware that prior to the invasion, China had phytosanitary restrictions against Brazil corn. So even though we went through MIR 162 and all this kind of stuff, China did not allow imports of corn from Brazil. Immediately after the war began, China began renegotiating with Brazil over this issue. And in November of last year, consummated an agreement which allowed China to import Brazilian corn without phytosanitary restrictions. So you can see here that China's supply of imports from Brazil went up to 67%. And indeed, that's exactly what's happened in the past few months, as Brazil's the dominant player in international corn, supplanting exports that would have come from the US Gulf and would have come from the US P&W. So even though we talk a lot about what happened in Ukraine, probably more important is this phytosanitary relaxation in Brazil. So this shows just a slide from earlier this week, and it shows the exports out of Black Sea. And that, let's see, the blue line, the dark blue line, shows the exports out of Odessa. You can see that more and more is going out of Odessa. Even though it's constrained, the light blue line is through Constanta and the other ports. So things are rebounding in Ukraine. Jamie, you want to make a few comments on ag tech? I'll just make a few comments of importance here, and then I'll draw a summary. So these countries are competing a lot now in agriculture technology. And I think the lead ag technology is being developed primarily in the United States, Canada, Brazil. But one of the biggest problems for Russia today actually is because of sanctions, they don't get access to Western technologies. So whether it be GM crops or ag chemicals or ag machinery, they don't have access necessarily to ag technology. And so this is kind of an important issue. And we've seen a pretty robust investment in ag tech. And the slide I'd like to show the importance of it and how this changes agriculture. This is soybean area in 1995 in the United States. I think if we showed canola in Canada, it'd be the same story. This is before GM soybeans was commercialized. And the right-hand side shows the same slide in 2021. And the lower slide shows my region of the country, where now my county that I live in has gone from soybeans being a specialty crop to now my county is the most dense producer of soybeans in America. So the soybean belt has shifted northwards and westwards and across the border into your country. We could show the same in corn, the same in canola. All of it's showing us this geographical shift in production towards what we call technology crops and away from the non-technology crops, which is a problem for them. So that's illustrative of how important ag technology is. But this has evolved over time, and I've been involved in it since the early 2000s. And in 2008, we invented a word called the 9 billion people problem, which said that population growth and consumption is growing faster than technology growth and productivity growth. So we're going to have a calamity by 2050, where we're going to have to double our production. So that said, there's great opportunity in ag. So in that time period, 2004 to 2008, there's a lot of investment in ag, and at that time, that commonly meant agricultural land. And the big insurance company, Hancock, was the leader in this, and they said famously that ag was a perfect investment because it was inversely related equities and positively related to inflation. And that's exactly what's happened. So we have research, which traditionally in this country was dominated by the public sector, is now more and more private research and development. That was resulted in a shift now from agricultural land to agriculture technology, dominated by the big companies in those days, including Monsanto. I've been involved in this since 2002. And if I were to reflect what was sort of the deal that kind of caused this shift, and it occurred in 2013 on the right-hand side, this is the new private sector investing in ag technology. You can see the bottom was in 2013 at about $2 billion, now pushing about 50 or 60, I think the most recent year is $65 billion. And I kind of think the deal breaker that really chose this switch was the acquisition by Monsanto of Climate Corp. They paid $1 billion for it. And everybody said, you're crazy. I was involved in that. Rob Fraley said, we're not crazy. He said there's $20 billion worth of data in that acquisition. That was his words. And that has really come to pass. But it gave a signal to everybody in the world that there's money in agriculture technology. Let's start investing in it. So we had all these new ag tech venture capital companies and venture capital groups that started investing in ag technology. More recently, all of them point to the 9 billion people problem. They point to ESG. We had Blue River acquisition and others, which have really been prompting this investment in ag tech. And if you start reading about this very closely, you're going to hear about the words vertical farming and controlled environment agriculture, what is now commonly called Ag Tech 1.0, which is genetics, pesticide, and fertilizer, and Ag Tech 2.0, which is now what we're in, includes digitization, data science, alternative supply, and labor force issues. So that's where we're heading in ag tech. In my state, in my university right here, we created something called Grand Farm, which is kind of been prompted by the word autonomous everything. And that group of characters in the upper right-hand side there includes my governor. There's a farm out here in North Dakota of our senator. Jake Jornston owns Bushel. And over here we got Barry Batchelor, who started his career as an electrical engineer at John Deere, was involved in the development of the yield monitor and digital implements for John Deere, started a company called Phoenix, making electronic digital gadgetry that was acquired by John Deere, started another company called Appario, which was recently acquired by AGCO as a way for them to leapfrog themselves into digital agriculture. So we now have a farm, 40 acres, which is an autonomous farm located there, again, driven by farm demand, shortage of labor, IoT, and software. So we're doing some work on this. These are all the autonomous companies who are working in this. John Deere certainly is the leader of it, but everybody's trying to catch up to where John Deere is, including these companies like Raven and AGCO and others. And I want to give this pitch here because I'm very familiar with this company. It's just north of where you are. This is these guys are located in Edmonton, which are creating a digital imagery process to create a more efficient plan for driving implements across fields. These are delightful. One of the companies I do work with, they're invested in this, and they're doing a lot of work in Ukraine on how to demine the agriculture sector. And this is their own information on how their software results in a 25% improvement in efficiency, 30% improvement in machinery utilization, and 20% reduced cost. So that's digital agriculture at its finest. So digitization of everything. I'm on the board of directors of Bushel, which is a digital farm marketing company. We started out very simply that the cost of executing physical transactions was a lot of money. We did the calculation and concluded in order to get physical signatures, on average, every contract costs about $40 to develop. We thought we could do this as a digital app, so we created Bushel and initially could do it at less than $5 $5 per contract. So that's where our entree into this. But since then, we've grown to include now bushel mobile. This is active in your country, bushel trade, bushel fulfill. And we now have released something called bushel wallet, which is a digital transfer of money. And you'll love this story. You know, it's like an ATM where you can do everything digitally. And when this was being developed, the boardroom discussion was, well, normally farmers would sit on their checks maybe 2 or 3 weeks before they'll cash it. We said, well, we can do that faster in a wallet, digital. And then we had a debate about how fast is fast. And the debate was, is 5 minutes fast enough, or should it be less than a minute? That was the debate. So this is now active and live, and going to have a big impact. And we acquired a farm management company called Farm Logs. Today, we have 2,000 origination facilities. 40% of the grain in the United States and a similar amount in Canada uses the Bushel app in acquisition. We have 61,000 active users. Digitization is everywhere in Ukraine. They say that they are fighting on a shoestring because they're more digital than the Russians. So there we go. Having said that, I do a lot of work in logistics, and here's one of our major suppliers and supporter of me is the Senex Harvest States. And we have a labor shortage, as you know, and we have digital things that can do things better. And they created a digital elevator. Herman, Minnesota, where the farmer delivers his grain with or without an operator. They grade it, they bin it, and do everything digitally. And the farmer's got a credit card with his money in it. And I asked Rick Dusek, my student who runs all this, you know, how's it working? He says, working great. I said, what are you doing about it? He says, well, we're building 4 more of them. So that's where we're headed. So what does it all mean for you and us in agriculture? It just means more risk. And I emphasize this. This is my friend Dean Bass in Africa last week. And he says we're going to have more volatile markets. And we not only have more volatile futures markets, but we're going to have greater volatility in bases in all elements of logistics, handling, and margins. So when we talk about volatility, we measure volatility. On the right-hand side here shows Minneapolis futures as we went into the invasion and after the invasion, and the lower part of the graph shows the volatility. Now, volatility is important because that affects option premiums, and affects investments, and affects everything. And you can see how volatile the market began as we started rumbling about going into the invasion and in the post-invasion period. On the left-hand side, this is volatility going back to 1982. The orange line is our measure of volatility. You can see it's typically around 10 or 20, but in more recent couple of years, it's more like 30 or 40. What does that mean? More risk. It's two or three times more risky than it used to be. So volatility in futures is normally thought to be related to the stock use ratio. Now, the right-hand side of the graph, it shows volatility on the vertical and the stock use ratio on the horizontal. It says there's a bit of a relationship there, but it's not perfect. And the reason it's not perfect because we have very extensive geopolitical intervention, which causes this relationship to become quite a bit distorted. Here's the volatility graph again. I showed this a year ago to Bunge's board of directors to make my point. Normally, in the case of wheat, the volatility is 0.15 as we measure it. At that time, the volatility is 0.49. And the Saturday night that Putin decided to withdraw from the grain corridor, the volatility went to 0.8. What does that mean? More risk. But normally when people say more volatility, they mean more volatility in futures. But I want to tell you, we're having more volatility in everything else. Here's the basis. This is the protein premiums at the Minneapolis Grain Exchange from 1980 until current. And so you can see on the upper right-hand side, that shows every crop year. There's a lot of volatility in that from crop year to crop year. And it shows it longitudinally on the bottom graph. Normally, that standard deviation is about 10, but in recent years, we've seen it around 30 or 40, more basis risk. So whether you're a farmer, trader, investor, processor, that's more risk for your operations. We did a study in corn, which determined the time that there was a structural change. This is on the international corn basis. And remember, COVID hit in February of 2020. but we found a significant structural change in the volatility of international basis values in July of 2020. And you can see that black bar there, and to the right of that black bar, that's the volatility of the bases internationally. Ukraine, Brazil, Argentina, US Gulf, and US PNW, so more risk. But commodity companies make more money when it's volatile. In 2022, every one of these companies announced record profits or record increases in profits. And if you read the details about it, they attribute it to the more volatile marketplace. So what does that mean for you and participants in the marketplace? I just say, increased risk. We can't do anything about all the stuff that's going on, but we're going to have more volatility in futures bases and shipping. We're going to have changes in commodity flows. Certainly your canola oil going to the United States is a big change. We're going to have a 72% increase in soybean meal being exported, which is a big change in commodity flows. So those are probably the message I want to leave with you. From a strategy perspective, on the left-hand side, it means we're going to have more opportunities, but more challenges and more risks. On the right-hand side, it probably means that we're going to have more volatile times. Companies want to be expanding to exploit the opportunities, but they're more risky. And probably like normal in fixed cost industries, we overexpand and then have erroneous competition. So on the right-hand side, from an investment perspective, I want to kind of talk about this because I'm on boards of 4 companies. What this really means is, I think it's really important that you incorporate risk as a measure somehow when you do project pro formas. Most companies will want to diversify either vertically or horizontally. I think probably most companies are going to want a faster payback because they have more uncertainty. And then we got this word called stranded assets. And I never heard that word before a year ago, but one of the major commodity companies had me speak to their board, and they have an army of people studying where to be invested. And said, what's your challenge? They said, stranded assets. I said, what do you mean stranded assets? They said, well, making an investment someplace geographically or an industry that for whatever reason becomes uneconomical in the future. And then so he gave me an example, in soybeans, each new plant is $500 million. And the biggest risk to us is that if we invest $500 million in an asset that's going to last 50 years and have something change, so after 5 or 10 years, it's no longer economical. And I rolled my eyes and I thought about climate change and droughts and river shortages, but I thought about it in my own case. In North Dakota, we have one plant, we have 2 plants built in North Dakota.
William, sorry, I'm
malt
just going to
plants.
interrupt. We'll get you to wrap up. We got to keep
This
moving
is the last slide.
Okay, perfect.
Malt plants built because all the malt and barley was grown here. And now one of them was shut down for 5 years, and now it's more recently been converted to soybean crushing plant. We have another plant, likewise, discovering to be stranded assets. So I think that's a big risk for agriculture. With that, I'll close. I'll turn off my slides, and Jamie, I can take questions for a few minutes if you like.
Okay, sounds good. I think we have probably just time for 1 or 2 questions. There is one in the chat here from John Kolk is asking why Africa is not a player in global grain export/production.
Well, first of all, South Africa is. That's number one. And North Africa is a major producer of wheats and cereals. I think probably my response would be agriculture has a lot of potential, and that's why China's investing a lot of money there now. But I had a friend of mine who was a very senior guy and a major railroad person, and they toured there and said, nobody's going to invest in Africa, private sector money with all the corruption that's there. And until or unless that corruption is gone, it's going to be hard to justify private sector investment in those countries. That'd be my response. Other questions?
What is the current risk and possible impact of national food security for all nations?
I think substantially greater than it used to be. Though we're sitting in North America, we're kind of laughing and high because we got plenty of crops. We didn't have a drought or something like this. But if you go around the world, we got crop problems in Italy, we got crop problems in Mexico, we have protests because of food price inflation. And I think The risk is elevated in part because we've taken so many commodities out of food production and into biofuel production. And so the risk is elevated. And the advice I give countries and governments, it tells you if you're controlling the industry by government, you got to carry more stocks. I mostly do work for private sector processing companies. I have 5 of them. And everything we talk about is building stocks, carrying bigger inventories, because it's the most efficient way to secure yourself against those types of risks.
Just going back to something you said earlier, could you provide examples of how consumers could be buying further forward?
Yeah, so I'll use the United States as an example, and then I will talk internationally. So I have a lot of friends in the processing industry, and I found I'd always ask if we were in a meeting, it's how far forward are you buying? They'd always say 90 days, 90 days. I said, well, that's pretty amazing. We got farmers who are planning 18 months forward. We got railroads who are investing 36 months forward, and you're planning 90 days forward. I said, how can that be? He says, well, in the United States, we set our prices quarterly. So then we buy everything every quarter for the quarter. So our scope is 90 days. That was 10 years ago. Today, I advise 2 major flour milling companies. Many of their customers now are buying 6 to 9 months forward, if not up to 12 months forward. And what they're trying to do is lock in all of the elements of price, futures basis, shipping, fuel service charges, as far forward as they can in response to the volatility. Now, internationally, because some countries still have government buying agencies, they're buying very short-term forward. Algeria is tendering this week now in December for shipping in January. Well, that's not very far forward. Whereas I know COFCO and China, they're buying quite frequently. They're buying soybeans today from September all the way into March. So they're buying 6 to 8 months forward. That's what I mean by buying forward as a way to lock in the elements of price and allow supply chain partners to plan their logistics. That's what I'm referring to.
Okay, thank you.
Other questions or comments?
Okay. Thank you very much, William.
All
I
right.
think we'll have to wrap it up there.
Yes.
We do have our next presenter on the line ready to go. So thank you very much for your time
Yes.
and your patience. I thoroughly enjoyed your presentation, and unfortunately, we're just not able to take any more questions. I'm sure there are more out
They
there.
can send me a note separately if they want.
Perfect. I appreciate
right.
the offer. Thanks so much.
Yep.
Okay.